Hi, I'm Rick Kahler, and thanks for joining me. Well, here are 3 points about life insurance that many life insurance salespeople would prefer that you don't know. Number 1, not everyone needs it. Number 2, those who most need it are often least able to afford it. And 3, it's not a good investment. So let's take a deeper look at each of these. The first one being not everyone needs life insurance. You probably don't need life insurance if you're single, financially independent, don't have large debts, or own property or a business that will be liquidated upon your death. You need life insurance only if anyone would be put at risk or suffer financially because of your passing. Here are 4 circumstances that I think when insurance is typically going to be necessary. First one, say parents with young children. Before the kids are born, young couples who typically are both employed may not really need life insurance. However, when that first child comes along, it's imperative that there's enough insurance to raise each child to financial self-sufficiency. Second, business owners with large debts, key employees or partners. Without life insurance to pay off business debts, an owner's heirs might struggle to keep a company going, or they may be forced to sell it. Companies often insure the lives of key employees whose loss would severely impact the business. Life insurance is also routinely used to fund what's called buy-sell agreements, which specify that the estate of the deceased will be bound to sell and the surviving partners will be bound to buy the decedent's interest in the company. This is especially important for a minority partner who just couldn't afford to buy the shares of a deceased majority owner. Third, employed spouses close to retirement who haven't fully funded their retirement plans. Now, this is one that's commonly missed. If a surviving spouse depends upon several more years of a retirement plan contribution from a partner's salary in order to fund an adequate retirement, life insurance could make up that difference. And fourth, people with large estates, and I mean over about $11 million per individual, and especially if that $11 million is pretty much made up of illiquid assets that cannot be easily liquidated. Now, this is pretty rare, but we do see it occasionally, and it may certainly apply to farms or ranches where nearly 100% of the value of the estate is in land or a closely held business. In order for someone to pass the land or the business on to heirs, it's important to have enough life insurance to cover estate taxes because it's very hard to sell just a portion of a business or a portion of a ranch to raise enough money to pay the taxes. So those who most need insurance but can least afford it, well, they're often young couples with young children. Typically, these are the years when couples struggle to make ends meet with the demands of student loans and house payments and the costs of a growing family. The good news is that term insurance is usually very inexpensive. And the third point that I made, that life insurance is not a good investment. You know, in my 35 plus years of doing financial planning, I have never, not once, seen anyone fully or even partially retire on life insurance investments. One reason why is that a significant portion of the premiums in the early years of the policy go to paying out commissions. The loss is really never made up, and it takes years just to get back to even. This fact is cleverly hidden in the sales materials that lead you to believe you will never lose a dime, receive guaranteed returns, and get a tax-free income for life. These claims are true, but they are not the whole story. When making decisions about life insurance, remember that it's not meant as a source of income, but as a means to replace income or to pay taxes or debts. Used appropriately, life insurance is a valuable and affordable and an important financial planning resource. Thanks for listening.